Bloomberg Audio Studios.
Podcasts, radio, news.
Hello and welcome to another episode of the Odd Lots podcast. I'm Tracy Alloway.
And I'm Joe Weisenthal.
Joe, this is very special. This must be our fastest turnaround time on an episode ever.
Well, it is election day.
Yes.
I think we had technically a faster turnaround day on the day of the Baltimore Bridge collapse.
Okay, fine.
But,
fine.
yes.
But this was like 4 hours of content that we are squeezing into a very timely episode. So what you are about to hear is a live recording of the Odd Lots podcast, multiple panels, multiple conversations that took place on November 4th at a recording in front of a live audience in New York.
That's right. So today is election day. Last night was election eve. We figured a bunch of people, if they have preferences in this election, were probably anxious, looking for something to do other than just sort of refresh the internet and refresh Twitter all night. So we figured, why not get some of our favorite guests over the years from the podcast and get our fans, who we always love seeing, our listeners, and hang out and talk politics and policy for a little while. And I didn't drink, actually, but some people drank.
I stress drank. I'll
You
admit
did?
it, yeah.
I didn't.
But what better way to spend election day than listening to some live recordings of the Odd Lots podcast? So what you are about to hear is a selection of the conversations. We had some amazing guests. So we started with Zoe Liu. She is, of course, a senior fellow for China Studies at the Council on Foreign Relations. And we had her with Jordan Schneider of the China Talk podcast. We've spoken to both of them before, but we had a great conversation about what's going on in China right now and what could possibly happen with U.S.-China trade.
Right. And then where this particular episode will pick up, then we had a conversation with Neil Dutta of Renaissance Macro Research, Skanda Amarnath, Executive Director at Employ America. And we had a special guest that we kind of have to explain here for a second, because otherwise some of the conversation might not make any sense. We had Zvi Mowshowitz, and he is a prediction markets bettor. He's a writer. He's a legendary designer of Magic the Gathering decks. He's an advisor to Polymarket. He used to be a Jane Street trader. We're going to have him on sometime, Tracy, just for like a totally separate
He was
thing.
great. I just want to talk to him about deck construction.
Deck construction and Jane Street. Let's do like that episode.
Okay, but Zvi, in addition to all those things, set up a betting pool on Manifold for which podcast he would actually appear on in 2024. And one of those options was Odd Lots.
Right. He set it up at the beginning of the year. And so there's all these different possibilities. Which podcast will Zvi appear on? And just again, to sort of set the stage, we never announced that Zvi was going to be part of this.
He was our mystery guest.
He was our mystery guest, but we flashed the market onto the screen behind us while we were at Caveat, the place where we recorded the episode. And then during the conversation, we watched as the market slowly repriced.
Repriced up and down.
Yeah, it was very strange. My belief in efficient markets has been completely debunked.
No, you know what it was? This is actually really interesting. There was someone in the audience who was using free Manifold tokens to bring the probability down, even as Zvi was actually on stage. So a live experiment in how prediction markets work.
How they actually work, right. Well, actually, one of the things you'll hear is Zvi talks a lot about one of the constraints in prediction markets being capital constraints among traders.
Yeah.
So here is a guy who apparently had no capital constraints because he had free tokens, and you see how much that destroys that. So we started off that conversation to about all things markets, finance, what to watch for, polling, what to watch for in tonight's election.
Yep. And then our headliner of the evening was Brad Setzer. He is, of course, a senior fellow at the Council on Foreign Relations. One of our favorite guests. We've had him on, I can't even remember how many times
now. 9
now.
times now, probably.
Yeah. He was also a trade advisor to USTR's Catherine Tai under the Biden administration. So someone who definitely knows what's up when it comes to, I guess, the sausage making of trade policy. So a fantastic group, a great evening. Big thanks to everyone who came. And if you weren't able to make it in person, we hope you enjoy this version.
Right. So start off, check out our conversation with Skanda, Neil, and Zvi. We have some great guests coming up. And
now's your chance to make money.
Now's your chance. You can place
Get
a
on
bet.
Manifold.
We have one of the people, I'm not going to say who it is, but one of the people that we will be having on the show is an avid prediction markets trader, expert in this area. And I'm not going to say who it is, but
it's a mystery,
it's
truly.
It's a mystery guest. So let's bring to the stage, in no particular order, we have Neil Dutta of Renaissance Macro Research, frequent Odd Lots guest. And we have Skanda Amarnath of Employ America, another frequent Odd Lots guest. And we have Zvi Mowshowitz. He's a writer, trader into prediction markets and stuff. And currently on Manifold Markets, there's a 20% chance that he appears on Odd Lots in the year 2024. So we're doing a little test of prediction markets, efficient markets right here live on stage. So thank you so much. He's ready to insider trade. He hasn't insider traded on his own market yet, but it's just sitting there. We'll see. We'll see
if the odds move.
We'll see if the odds move.
They should be at 100%. So,
Yeah. Well, I guess prediction markets are debunked if they don't immediately move to 100%. Actually, Zvi, let's start with you. When you look at any prediction markets, and you're also advisor to Polymarket?
Yes, I'm an advisor to Polymarket.
So you're a trader, prediction market guy. Oh, there it is. It moved up to 44%.
It works.
It's still not high enough. It's still...
I mean, someone's not sure,
He's
right?
literally on stage. Folks, he's literally on stage right now.
How do you know to bet yes, but you don't think you should take it farther?
Yeah, man. It's up to 4. Okay, whatever. Maybe if someone... Oh, there it is.
There we go.
Someone tweet this out. There's still 14% gains to be made. The IRR of 14% in 30 seconds is incredible. Anyway, when we see these odds, not for this market apparently, but when we see these Polymarket and Kalshi odds, et cetera, they say whatever, how seriously should we take them?
I take them at least as seriously as any other data point or source of information that we have available. They are the best thing we have.
It's up to 94%. There's still a chance that you're not appearing on this stage right now.
Yeah. Wait, why they're the best thing we have? Please explain in the context of this still being stuck at 94%.
Well, if you're on the internet, what other source do you have other than the actual broadcast? Obviously, if you're looking at the poll, not just the polls, but the actual ballots, and you're like, oh, I guess we know who won, then that's better than a prediction market. But anything short of that we have is going to be incorporated into the prediction market, right? So the polls, the aggregations, the projections, all of that gets worked into how we trade the prediction markets. So for the prediction markets to be wrong, there has to be a systematic mistake, and those mistakes do happen, and you can in fact profit from them, but they tend not to be very large.
Neil, what about real markets? And you're always watching what's happening. Well, I said real markets. The ticker DJT. What's happening in rates, maybe regional banks. What are you seeing over the last few days, or what are you going to be sort of watching in terms of the real markets and how they trade?
Well, I mean, my work suggests that the sort of Trump trade, particularly with respect to fixed income markets, wasn't so much Trump, as it was just stronger economic news. You have to remember that the increasing probability, at least up until recently, that Trump would sweep into the White House, that was coinciding at a time of meaningful data surprises to the upside. We had a strong jobs number, strong retail sales, jobless claims have been low. So I think it's less about politics and a lot more just about the data as it's been coming out. In terms of what I'm going to be watching in particular, my sense is that people will just replay the 2016 playbook if that's what happens. And if you get the alternative, in which case I think it's likely that, a Vice President Harris wins, you probably get a Republican Senate. You probably see, a rally in fixed income.
Skanda, what are you watching? Because with polls, so obviously there's a lot of, people have strong opinions about the usefulness of polls. I kind of think who is answering the phone anymore? If an unidentified number is calling them, it feels like there's a bias towards a certain demographic that's actually picking up the phone. But what are you watching?
Yeah, I think there's a clear limit on what polls are going to be able to tell you beyond a certain point. I think that itself just kind of tells you it's close. It's probably 50-50. Your ability to discern whether it's 50-50 or 60-40 is pretty limited even. Like you could make a case for 60-40 for either side. But beyond this, like we don't have a lot of information that polls tell us. Polls are scammier now.
What do you mean by that?
There are some establishments that seem a little less scrupulous, that do a good job of gaming the rating systems. So I guess like to give the finance analogy, so passive versus active, like the idea of just like, okay, just trust the aggregation more so than individual polls. But now we have like a weird set of partisan or quasi-partisan pollsters that come in, less transparent methodologies, and the attempts to make process to better understand who's better, who's worse, is not great. So we actually have like aggregators that I don't pay as much attention to relative to just like, okay, if there's a good poll from whether it's a Republican establishment or Democratic establishment, there are some good ones on either side. I think that's got more information in it. But even then, it's like very limited. There's a ceiling. I mean, I'd be more curious to see about the geographic distribution. So obviously the swing states come out 7 p.m. onwards. We get some early states that report early but are red. So just seeing the geographic distribution is going to be kind of interesting because that's actually the polarizing thing I see, which is urban versus more democratic trending suburban versus rural. And it's like ultimately about the margins and how those shift relative to 2020. That's like still not really clear about how many new Trump voters can come out of the woodwork. There were a lot in 2020. And how much will a lot of those suburbs swing further to the left? Yeah, these are all kind of open questions. And I don't think we have great ways of benchmarking probability beyond a certain point.
Zvi and Skanda, maybe. Can you explain the herding controversy? I've been seeing a lot of tweets like, oh, pollsters are herding. And what's that? And then, I don't, how do you herd exactly? Like, what is that all about? Like, what are they doing?
So the idea is if you have a poll and you come up with the same result as every other pollster, and so everyone is saying Harris +1 or Trump +1, you come out with Harris +1 or Trump +1 or 0, then no matter what happens in the election, this is not your fault, right? You didn't screw up. But if you were to say Harris +4 and then Trump wins that state, then suddenly everyone looks at you and goes, you're terrible, your career is over, you're an idiot, and to a lesser extent if it's Trump +4. So what a lot of these pollsters are very clearly doing from statistical analysis of the polls is they are cooking their books, putting their fingers on the scale to make sure that their number comes back very close to what everyone else is saying. And there are only a few, like New York Times Morning Consult, that are clearly not doing that. And often they'll also do this thing where they'll take a poll and they'll see the result is like way off, and then maybe they just won't release it, or they'll find a way to adjust it, or whatever they have to do. And Nate Silver posted recently on Twitter, the chance of all of these polls coming in this close, even if the race was actually tied, was on the order of 1 in 9 trillion. So it's clearly just not a coincidence.
So what actually happens on prediction markets on election night? I imagine like things are going to be moving quite a bit. But also, when does the actual payout occur for Trump versus Harris?
So the payout depends on the exact terms of the contract. So 4 years ago, we had a lot of very interesting discussions going on behind the scenes and a lot of very public yelling as different sites proposed to pay out based on the fact that Biden had actually won the election, and other people very much disputing that Biden hadn't won the election and in fact buying Trump long after Biden had won the election.
That was weird.
Yeah, I made some money on that. That was kind of awesome. And so, I mean, like the bets before election day, they did okay. I won them, but I should have held my money. The bets after were so much better. But the way it works is there's a technical rule for when the bet pays out, and this can vary based on where you bet. So, one of the ways to do it is you say, okay, if the networks call the election, then that counts because they're being very conservative these days, and then we pay out immediately, no matter what happens. And that way you don't have to hold it for weeks and weeks, including if there's another dispute, which, we all hope there isn't, but you never know. Trump, that could easily happen.
It occurred to me, so you're now at 96% chance of appearing on Odd Lots. It occurred to me there may be some ambiguity of the rules because this audio could, I don't want to jinx it, but maybe it never comes to see the light of day. And so maybe just the same way people are wondering the technical rules of your contract here and whether interviewing you on the stage is the same as appearing on the podcast. Let's get to a little macro. Neil, monetary policy. Have you been contacted about being either the next Fed chair or being on the FOMC in the event of a Trump victory?
What are you trying to say?
I am not saying anything. I'm simply asking whether the transition team has reached out to you about a role.
I have not been contacted, and I wouldn't expect to. Though I know people that traffic in those circles.
Okay. What do you like when you think about the medium-term trajectory of monetary policy under a theoretical Trump administration or a Harris administration? Does tomorrow night sort of change your outlook on that type of policy?
Not really. I mean, I think in terms of what I typically do, as you know, I don't let political outcomes really affect my kind of near-term decision-making in terms of what my monetary policy call is going to be. I think the next few rate cuts are really just baked, I mean, regardless of who wins. And that's because I think the underlying dynamics in the economy are still kind of pointing to slower growth, benign inflation, and probably ongoing monetary policy recalibration. So I don't think that's going to change, before the first quarter of next year. So I think they'll keep cutting. It's really just about how much they will.
Skanda, I'd be curious to get your take on this as well. Like, what kind of economy, or how would you characterize the economy that either Harris or Trump will inherit?
So, I mean, all things considered, like, employment's still very high. Inflation is generally falling. I mean, each month there are bumps. That's not a bad hand to be given. Productivity growth looks like it's picking up a gear, at least for the time being. All of these things are pretty good. At the same time, to Neil's point, there are going to be we're seeing signs that growth will be slower in Q4 and probably Q1. And for that reason, like, we're kind of seeing some bumps in the road. I don't think that policy is going to be changing on a dime, even if, like, Trump goes for really aggressive tariffs. These are not things that will be done overnight. And so that's like the kind of friction in the system. Everyone likes to talk about politics and how it's relevant to markets. And there will be some election reaction. But it's like, as 2016 kind of told you, right? Whatever correlation structure was there pre-election doesn't have to be there post-election. And I do think that's like something just to be mindful of as far as like policy will take more time to change. I think it's pretty clear that if it's a Harris administration, it's probably with the Republican Senate. There's like some compromise on tax policy. You're not going to get big things done, but I don't think there's even like a huge appetite within the Democratic Party to do big things. That's a little different in terms of like they've already passed a lot of legislation, right? But in terms of Republicans, they actually have a good shot at a trifecta, right? And if that happens, then the box opens up. They might cut corporate taxes more, but there's also more discretion on like trade and immigration that Trump could wield.
Well, I was just going to say, I mean, if you go back to 2017, remember that discussion around monetary offset? We were all talking about monetary offset because the idea was, well, Trump is going to be this sort of inflationary demon, and the Fed has to do all this sort of rate hikes to offset it. And in hindsight, there wasn't really a monetary offset. They ended up doing more or less what they were planning to do. So, I just think it's important to kind of try to separate these things out and just sort of take the world as it comes to you. I think that's, as opposed to trying to forecast and front run sort of potential fiscal outcomes. I mean, if you're the Fed.
Zvi, do you see anyone? Whoa, you're back down to 50%.
Oh, how did that happen?
You've fallen. Someone hit the sell, and apparently the order book must not be. They're like, all right, I'm going to take my profits at 96%. And I guess the order book was pretty thin because whoever just sold you like really got a bad price on that. So you shouldn't have sold whoever that was. Oh, okay. There you go. We gotta get some liquidity here. Is anyone doing like? Do you see people in your world trading cross between the prediction markets and the real markets? I don't know what to call them. All market, Do you see much of that where it's like, this level of confidence in Trump is not consistent with this thing we're seeing in, I don't know, Bitcoin or something like that? Are you seeing much of that?
So you earlier asked what happens on election night.
Yeah.
And what happens on election night is that the odds will move dramatically and they will respond very quickly to every piece of news. And there's both the reaction that happens when the news is available to those who are paying attention. So like if the counties file their numbers online, there are some people who are downloading the information from the counties and they have their spreadsheets ready and they're analyzing all the details and they're trying to stay ahead of the game. And then there's the people who are watching the news and they're like, oh, the network called Wisconsin. And then they suddenly, the money comes in. But of course,
it's kind of embarrassing, isn't it? Like I remember that last time, like the people I was following on Twitter clearly knew stuff before the official calls, and yet the market seemed to react to the calls in many cases.
That's right. So if you know what the calls are going to be, you can clearly make some money by doing something before the market moves. But this is often true of there's one set of people who have one set of information, and another set of people who have a different set of information, which is coming to them slower, right? They're more square action. They're less sophisticated, and they still help make the market more accurate in general, but they're often predictable somewhat in advance. But there are transaction costs.
Neil, I know one of your
people only have so much capital. Like all the major players on election night are going to be somewhat capital constrained in the prediction markets because they're often going to see there's some sort of systematic mispricing or some sort of opportunity, and they're going to have to watch their bankrolls and make sure they don't spend too much. Right. So we're in a situation where everyone's looking for these big mispricings, but then like you have these different waves, and then one of the things that you notice is the early movement on the prediction markets is often actually ahead of the financial market movements and things like currencies and things that are open. And you can, in fact, make money for real if you are watching about this because the beta thing is real, right? So like you go into election night, you say, okay, what is going to be the Trump, beta for everything in the world, right? Every currency exchange, every index that's still trading, whatever you can get. And if this was going on during market hours, it would be so much more fun.
Wait, who's actually trading on the prediction markets? Like, walk us through the typical person who's doing this and whether or not that introduces some bias into the probabilities. Because I imagine, for something like Polymarket, you have to have a VPN, you have to be somewhat crypto literate.
Fluent, yeah.
Yeah. So, does that influence some of the numbers that we're seeing?
So you could be a French multimillionaire. You could be a Scottish teen, is the other traditional joke. But the answer is, all types of people all around the world are getting into it. But yes, because it's Polymarket, you see a difference between Polymarket and, say, Kalshi or, these other sources, Predictit, that are allowing Americans in and that aren't crypto, because there's absolutely a bias in who has easier access to Polymarket, who wants to get involved in Polymarket, who's eager to do that. And that bias is favoring Trump this year. Trump is much more for crypto. You see these associations in various different ways. So Polymarket has been several points stronger for Trump than other similar prediction markets. And you could also, of course, argue that, no, it's Polymarket that's fine, and then everyone else is biased. And, who is really to say?
You're up to 98.6 now. Skanda, tell us more about what specifically you're going to be watching. You mentioned the rural-urban splits that even in the red areas, we may get signal from some of these things. Are there bellwether counties that are useful to watch? Waukesha County, Wisconsin is
Crucial.
a long time crucial. Waukesha County. Now you're down to 58%. Is there anything like that? Talk more about how you're going to be consuming the information tomorrow night.
Yeah, bellwether counties are basically fake, right?
Okay,
What matters, you can have, we've had it in 2020 and 2016, where
it's like p-hacking, isn't it? Because you can always find some county that always vote for the winner, but it doesn't necessarily mean anything. All right, keep going.
I mean, we have every county is moving somewhere at the margin, right? And every marginal vote counts. So if let's say Harris is really well at just trimming Trump's margins in rural counties, that's a big deal. In the same way that Trump's ability to amplify them in 2020 was very underrated by the polls, by general expectations among forecasters, that he was able to scale rural turnout, even the percent margins, which people obsess about, percentage margins in a lot of deep red counties did narrow in 2020. But just because turnout was ramped up even further, Trump got more margin. And so a lot of states were a lot closer than what the polls predicted. You find your ways to cluster the counties, whether it's urban, suburban, exurban, rural, whatever way you want to swing it. That cluster, every single one matters, right? Every part of it, there's going to be some movement among the urban counties, those that are trending blue, and every vote counts on all of them. So it doesn't really make a lot of sense to obsess about a particular county where if it flips from red to blue, that can happen at the exact same time. A bunch of red counties that are deep red become even redder. And that's what happened in Florida, for example, right? So we had Pinellas County was highlighted as that chooses the winner, and it wasn't. In 2016, it was Hillsborough County, and that wasn't, right? So these flipped blue, and it didn't really matter. And I think that's a good warning for a lot of this election night coverage.
Neil, I know one of your favorite things to do is to tear apart the ISM manufacturing survey. What happened to the vibes, the soft data post the election? And how should we measure it, I guess? Not the ISM, clearly.
Well, I mean, you mean when? Right now?
No, after the election.
Next week.
I mean, I think I would expect to see a pretty meaningful increase in consumer confidence and small business sentiment, primarily because, small business sentiment, I mean, that survey really skews, I mean, think about who's putting it out. It's the NFIB. What do? They're a lobbying organization on behalf of, right-wing causes. So my sense is that the small business sentiment number would go up a lot. Consumer confidence would probably go up a lot too. Whether that actually translates into real consumer spending, I have my doubts, but that's kind of what you saw after the 2016 period, right? And similarly, you saw a big decline in sentiment after the 2020 election. But again, that didn't really translate into what people were actually doing. So, I think 2016 was an interesting case because things like the ISM, which you mentioned, I mean, Trump was coming into office at that time at the front edge of sort of a global manufacturing recovery. So the so-called sort of Trump boom, I mean, it was an Abe boom, and it was you saw that in a Macron boom. I mean, everyone was kind of feeling it at the time. So it wasn't just U.S. specific. This time around, I mean, manufacturing, frankly, looks a little sluggish. I mean, there hasn't really been much. There's been a lot of construction of manufacturing facilities, and I know Skanda's been pointing that out quite a bit, but if you look at actual manufacturing production, it hasn't really been great shakes.
Is election uncertainty, and you see this like in the anecdotal comments on some of these surveys, whether it's the ISM or the Dallas Fed, which always has very colorful anecdotal aspects. Is election uncertainty real, or is that just a code word for people who prefer Trump hoping that that's the outcome and then that maybe changing their outlook?
I'm sure it's probably both. I think there's like some
Are
level.
there really deals not happening? It's like we don't know who's going to be president. I'm serious about.
Well, think about all the enacted legislation, right? So if you say there's if let's say IRA, maybe parts of chips that have come up under scrutiny, or parts of the infrastructure bill, if these are all things that are cast as these were all left-wing items that Biden passed, and if it's depends on whether Trump's going to be in office or not, if you perceive it as it's a 50-50 proposition, if Harris is in place, then it's going to stick. If Trump's in place, it may or may not stick. Then I can actually see a case for if you have any business attached to a government contract or a government subsidy, that might actually be genuine. I think there's also some partisanship though, obviously.
I think generally speaking in my career, I mean, you talk about these sort of formal measures of policy uncertainty, like the one from Nicholas Bloom that's widely cited. My experience is that when that index is high, it's usually a time to go long equities. Right? When policy uncertainty is high, it's usually a time to dip your toe into the market. It's a buying opportunity for stocks, historically.
Can we go down the line and talk about what everyone's day is actually going to look like tomorrow? How are you spending the election? Let's start with Neil.
So like I said, I mean, the election is actually a very small part of what I try to do on a day-to-day basis. I'll probably, just a front runner, I'll probably be spending some of my spare hours working on this piece that I was talking to you about.
Thank you. We have a new daily Odd Lots newsletter, and Neil has promised to be one of the contributors. And so we have a piece coming from him.
So it just sort of gives me an opportunity to kind of take a step back because I have no edge. I don't try to pretend to have an edge on political stuff. And, one of the things I've been thinking about is just the sort of, this neutral interest rate. I mean, the Fed's talking about it all the time. And just exploring the idea, is there a dual neutral rate? I mean, for example, the neutral rate for housing, whatever it is it's not working. Housing is not working with mortgage rates here. So the neutral rate for housing is clearly a lot lower than maybe it is for, say, the housing, the labor market. I don't know. So if you sort of buy into that, it would imply that the Fed needs to do a bit more to get certain areas of the economy going. And if the Fed's lost the ability to stimulate housing, I think that's a potential problem. So I'll probably be focusing more of my time on that as opposed to checking out the returns in, I don't know, what is it, Cuyahoga County or something? Yeah.
Skanda?
I too am working on a piece for your all loss coverage, so that's sort of forthcoming as well on productivity. But Elections are for people who like numbers changing and like following them, which is probably most of you, I'm going to guess, on some level, if you're interested in finance and markets. Yeah, it's just a fun exercise of like seeing how margins shift. I have some spreadsheets prepared for myself just to kind of track things if the New York Times needle isn't up and running. And yeah, I'll probably take it easy in the day, but maybe I'll catch a nap, and then I will probably be up till at least 3 a.m.
So as a writer, I want people to read what I'm writing, and I want them to think about it and pay attention to it and learn from it, and I want to influence them. So this past week has been a case of, if I write about something, no one's going to pay much attention to it because they're going to be focused on the election. And so I get to kind of take this time off because I'm not going to try and put anything up except for my weekly update until after the election is settled. So instead, I've had a chance to like program some tools that are going to help me write over the long term. I might go see a movie, have a nice long lunch, relax. And then, of course, in the evening, I'm going to absolutely be following. I'll have the prediction markets up in various windows and various devices.
How many screens do you have?
I have 3 30-inch screens, so I have one horizontal and 2 vertical on the two sides. Yeah, as a trader, you have 6, but now that I'm trying to stay away from that, like, I think that 3 is about right. And so, about one of them will probably be various prediction markets, especially Polymarket, and various different markets within them. So you need a lot of space. And then, you're watching the television like everybody else, and you're watching Twitter, and, you're just trying to get through it and process it, because that, like, even if you don't really want to pay close attention, like, what else are you going to do tonight?
That's right. What else is anyone going to be doing? Wait, real quickly, why has the spread on some of these markets between, say, Kalshi and Polymarket not been arbed away? What is the constraint to free money?
The constraint is liquidity and access to the market and the capital costs of committing the capital to multiple places, moving the money in and out. Everyone's kind of a little bit terrified every time they initiate any crypto transaction that somehow their money's going to vanish or something wrong is going to happen. I mean, it's very, very unlikely in any given transaction it's going to happen. But I definitely have an opinion, by the way. I want to be clear. Like, when I say, like, who knows which one is wrong, I very strongly believe that the Polymarket line is the one that is biased in the situation due to the access issues, whereas I think that the line at the other markets is much more reflective of what the line kind of should, in some air quote sense, be.
Actually, real quickly, Skanda, since you mentioned productivity, and I know you have some thoughts on productivity, Zvi. In fact, you just mentioned coding up some tools to make your life as a writing easier. I think you both have some different. You think we're going to have like 50% GDP growth in the coming year on year because of AI or something like that?
No, not 50% this year.
No, but no. What's your? Give us the short synopsis of what you think is coming for productivity growth.
I think that the skeptical line on productivity growth is we're talking about, percents per year, every year over the course of 10 to 20 years. And I think that's sort of the ultimate bear case for AI. Just doesn't do what we want it or expect it or hope it would do.
And the bull case?
Singularity, superintelligence, world completely transformed.
Great. Skanda, what's the gist of the productivity? And then also, Neil, but what's the gist of your productivity piece that you have coming for the Odd Lots daily newsletter?
Yeah, so just speaking in terms of the realized data, and I try to start from how's the data measured, what are we actually capturing, which may not be indicative of sort of conceptually what we associate with productivity, but productivity growth has actually outperformed post-pandemic in a pretty meaningful sense relative to what we were seeing pre-pandemic. So pre-pandemic was roughly 1.4% if you take sort of longer look backs. And we've been down over post-pandemic period, something like 2%. Maybe it's 1.9, maybe it's 2. But that's like on an annualized basis. That's pretty meaningful deviation. And there are like a lot of reasons why, but I think that it all kind of has to come back to like the measured set of transactions, inflation adjusted, divided by total hours worked. That is basically our most measurable version of productivity. It comes with lots of flaws. For example, Google Maps that everyone uses on a day-to-day basis, right? It's ad supported, right? It's not supported by a final expenditure. It should filter in somehow into our productivity statistics, but we don't have a great way of saying how. And estimating that's actually really hard. So for example, there's a lot of things that probably AI can make our lives very efficient in the same way the internet's made our lives very efficient, but it didn't necessarily lead to a lot of transactions. And that's kind of the open question that's like, for a lot of AI breakthroughs, how that leads to, it may improve a lot of welfare, but the actual nuts and bolts of how it leads to more people spending in ways that are reflecting real things and not price increases, that is like actually a big part of the ball game.
Neil,
any thoughts on productivity?
I mean, I agree with Skanda. The measured data is what the measured data is, or the data are. I mean, it's 2%. That's very strong. I think for what that means for me is that basically this is one reason why we should not worry about inflation. Okay, and that should give the Fed, plenty of cover, right? And this is something we talked about earlier in the year, right? Is that it's one thing to just see the inflation data, it's going up, without having like a rational framework for why it's going to keep doing that. And, the fact that productivity has been fairly robust over the last year, I think it means a couple things. Number one, we should sort of resist the temptation to kind of buy into the stagflation story. You can't really have stagflation if productivity is doing what it's doing. But it also makes the likelihood of like some inflation reacceleration highly unlikely as well. Like, where is it coming from? Unit labor cost growth over the last year is basically zero. So, for a Fed that has a very labor market centric view of how the inflationary process works, the robust growth and productivity that we've seen, I think, is an important kind of, story in terms of mitigating inflation risk.
if you had to choose, what would you say is the biggest constraint for Trump and Harris both? Like, is it political? Maybe like Harris gets in and doesn't have a trifecta like maybe the Republicans would have? Is it something like the deficit? Choose one for each.
Well, I mean, personally, I think that it's going to be, the markets have been sort of like, oh, the unified GOP. But I mean, even if it was to be a unified GOP government, the margins in the House would still be very, very thin. It's not like they can just steamroll whatever the hell he wants, next year. But I would probably say the bond market's the constraint. I mean, you have to be worried about what's the appetite going to be in the fixed income market to fund a huge sort of deficit, spending plan.
Skanda?
I go back to the politics. I think American government makes it very hard to pass things in general. And the wisdom of that, where everyone wants to debate, it's just even under a unified government, to Neil's point, like Lisa Murkowski still has a lot of leverage. Susan Collins has a lot of leverage. They probably will pass some things. It's easier to pass things under a unified government than under a divided government. But that's probably still the binding constraint. It was the constraint on Biden in 2021 and 2022. I mean, even though interest rates are going up, the real question was Joe Manchin willing to say yes to? And so even if we can debate what's the nature of public finance constraints, oftentimes they are reduced ultimately to the hardball legislative politics.
I've alluded to this before, and I don't want to let it shade my view, but I would like mortgage rates to come down in the next 2 years. Do we need a spending crackdown? Do we need to go into austerity mode to get mortgage rates back to roughly somewhere in the ballpark of the 2010s?
I mean, I would say to the extent you can free up real resources, right?
Yeah.
To the extent that you're actually reducing inflation or getting the Fed to be more confident about the willingness to lower interest rates, that would probably be the main mechanism.
I won't let my mortgage affect how I assess the economy, but I'm just saying.
But I think that's the tricky thing. You can do a lot of deficit reduction that doesn't necessarily move the needle on inflation or the Fed's reaction function. But healthcare costs, for example, right? Healthcare costs in general need to be constrained. They do have a pretty direct role in inflation outcomes. And because of those two things, that's a pretty strong nexus for if we could reduce healthcare inflation by 0.5 percentage point each year, that would be a very big deal for what the Fed would ultimately, you probably get to the last mile of whatever the Fed's trying to achieve.
Zvi, can you say a little bit more about the spreadsheet setup that, Skanda, you mentioned your spreadsheets too. As that data is coming in tomorrow night, I mean, this is what we really care about, right? The numbers start to come in, they get posted on Secretary of State websites, et cetera. How are the traders ingesting that in that process to be ahead of when the networks say they called Wisconsin?
So it's going to vary a lot from trader to trader, from house to house. And, a remarkably large number of people just don't do this. And that's clear because you look at the financial markets over time. I mean, I haven't followed the most recent elections 2022 that carefully in terms of the reactions, but you definitely see these delays. And if there was a lot of participants in the market who were keeping close eyes and incorporating that information instantly, that wouldn't happen. So The right ways to do it involve things like setting up automatic interfaces with these websites to just pull things into your spreadsheets, right? So you have your Excel spreadsheets that contain all of the county by county data from all of the returns. And then ideally, you want to figure out what that implies about the results. And the technically correct way to do that is a Bayesian calculation. It takes into account all the information because you don't know which pieces of information you're going to get. So you need to know how to feed them into your calculation. And then that should then output a range of distributions with various probabilities of various different outcomes. And you price that into your beta on various things based on those elements. And you figure out what the prices are supposed to be. And then you make the good trades. Be the goal.
Zvi, weren't you at Jane Street before? What was election night like there?
Well, I mean, all hands on deck, right? So everyone's there. It's a working night. And you use what tools you have, and you use what instruments are available for you to trade because it's the middle of the night. So obviously if the US stock market was open, everything would be dramatically different, but you are somewhat limited.
All right, I have one last question. As an AI productivity optimist, I don't know anything about how to code a system that will ingest all the data and set up a Bayesian model. In your vision of what AI could do, can I, in a couple of years, could I go to ChatGPT and say, write the code that will pull this in and then build some kind of model?
You can do that now.
All right. Zvi, Skanda, and Neil, thank you so much. I feel prepared. Zvi is at 91%. So there's still some ambiguity about whether he was on stage or not.
People are still unsure. All right, the final stretch here with Brad Setzer, Senior Fellow at the Council for Foreign Relations. Who better to tie up all the disparate things we've been talking about in the previous two sessions than Brad? We always enjoy speaking with you because we can basically throw anything at you.
See the record holder? It's close.
Yeah, I'm pretty sure you might be close to the
at
top
this point,
for number of Odd Lots appearances. But why don't we start with something really specific? Because you published a paper recently all about globalization. The title is The Surprising Resilience of Globalization, an examination of claims of economic fragmentation. And your conclusion was basically that we are still globalizing, and to some extent, since 2016, we've globalized even more. Walk us through how you come to that.
Well, first, thanks for inviting me, and thanks for asking me about my recent paper. You are the first person who actually seems to have read the whole title.
I promise I did actually read it. I read it earlier today, but I read the whole thing.
I'm impressed. And then thanks to everyone for sticking around. Appreciate it. So most papers, or many of my papers, originate out of a sense that a narrative has taken hold, and that narrative has sort of perpetuated itself, even when that narrative isn't fully backed by all of the detailed data. And there have been two narratives that have been, they're closely related narratives that have been very prevalent at the IMF, prevalent at Davos, prevalent in the financial media, prevalent on Bloomberg. One is that the world is deglobalizing. And the other, which is related but not quite the same, is the world is fragmenting. Different political blocs are interacting less economically. That thesis seemed at odds with a couple of things. One, I spend a lot of time, don't ask why, looking at trade in pharmaceuticals. It's an interesting subsector of the global economy.
It's a hobby.
It's a hobby. I'm certainly not paid for my odd take on the pharmaceutical industry. And the pharmaceutical industry has continued to globalize. U.S. imports of pharmaceuticals have doubled since 2016. U.S. imports from low-tax jurisdictions, which is a big part of pharmaceutical trade. It's not with low-cost jurisdictions, it's low-tax jurisdictions. About half of our imports are from 5 tax hubs. They've doubled. 1/4 of those imports come from the great country of Ireland. So that's not a story of deglobalization. That is a story of continuity. It's a story of globalization continuing because there's a tax advantage still to globalization. But then the other component of the argument is the one that sort of irritates people. I looked at the data. Everybody tries to look at the data. And, if you look at the data for China, biggest economy and the biggest potential source of fragmentation. I mean, you can fragment with Russia, which has happened, but fragmenting with China would be big. And I didn't really see the evidence. So China's exports to the world are up by of manufacturers, are up by about $1 trillion since 2019. So since the peak of the trade war, since the pandemic. China's imports are up, manufacturers up 200 billion. China's surplus of manufactured goods is up 800 billion. And I'm pretty confident, because I have some sense of magnitudes, that that's not all trade with Russia. There's a little bit which is trade with Russia, but it is mostly because trade deficits amongst democracies have risen. So the classic offsets to China's surplus are the deficits in the UK, the US, and India. Not geopolitically aligned with China, but the global counterpart. So my overarching thesis is the world has continued to globalize, but in unhealthy ways. Unhealthy because there's still a lot of tax-driven globalization, and unhealthy because this increase in China's exports is a reflection of deep weaknesses, which have already been discussed in China's domestic economy, which make China incapable of growing at the pace it wants without relying more, not less, on exports. So that's the theme.
A lot to chew on, and that's what we're going to do. But the trade war that started in 2018, does it show up in the data in any meaningful sense? Like when you look at the data now versus some counterfactual where tariffs hadn't been put in place, do you see fingerprints of it?
Yes. The most obvious is that, the U.S. is the one country that currently doesn't import any cars from China. And since the trade war, China has become the world's biggest auto exporter, and the U.S. market is effectively, for now, walled off. If you look at the bilateral trade data between the U.S. and China, the first thing to note is that they no longer agree. In the bilateral data from the U.S. side, we think our trade with China has gone down, and significantly. If you look at that same data from the Chinese side, China thinks its exports to the U.S. are broadly unchanged. Now, you can still say there's an impact because China's exports to Europe, the obvious counterfactual, have gone up. So there's some evidence of a bilateral decoupling. There is a lot of evidence of tariff avoidance. And then at a global level, there's no real evidence of a serious decoupling or fragmentation, because a serious fragmentation, in my view at least, is one where China runs a smaller surplus with democracies, where China trades balances amongst the axis of autocracies. And that clearly hasn't happened.
You mentioned earlier tax incentives to globalization. And I'm trying to think how to frame this question, but why are we so obsessed with tariffs if, the ultimate cost of a product is not the only thing driving decisions about where it's made and where it's going?
I mean, in all honesty, I think it's because Donald Trump won the 2016 election. And Donald Trump believes tariffs matter. Donald Trump is he's a tariff man. He really is. The other one is, look, there is absolutely no powerful lobby, that is pushing back against importing more pharmaceuticals from Ireland. And there's a very powerful lobby that wants this current pattern to remain. By producing outside the United States and moving intellectual property outside the United States, the American pharmaceutical industry has reduced its effective tax rate to roughly 10%. Why wouldn't you want to maintain that? The opposite side, the loser side, is mostly the taxpayer. There's not a lot of jobs at stake, although there's some. So a couple of shocking to me little nuggets. The U.S. pharmaceutical industry, top 6 companies, roughly made $60 to $70 billion in 2023. Top 6 companies. Those top 6 companies paid collectively, so a little bit of offsets, 0 in tax to the U.S. federal government. They reported losing money on their U.S. operations, even though the U.S. has well-known much higher pharmaceutical prices than the rest of the world. And they report making all of their profit and paying all of their tax in other jurisdictions. So everyone except the U.S. taxpayer seems to win.
What was the effect, if any? So one of the things, regardless of who wins tomorrow's vote, at some point there's going to be the Tax Cut and Jobs Act is going to come up. Though I think the corporate side is permanent. That part is going to be less controversial or not going to be a thing. But what was the effect of the Tax Cut and Jobs Act? Because there was some impulse, at least claimed, that, this will encourage companies to recognize their revenues in the United States and crack down on that to some extent. At least in the realm of pharmaceuticals, as you've described, that hasn't happened. What was the intent and what was the effect of that bill?
Look, first of all, you broke my heart by saying there's nothing that's going to happen on the corporate tax code next year.
Is there? I can't remember.
It is obviously going to be part of a negotiation.
Okay, yeah, that's right. That's right. Okay,
it is the great chance that we have to correct some of the flaws, in my view, in the tax cuts.
But the corporate side doesn't expire automatically the way some of the personal does.
So, how much detail do you want to go into? The 21% does not expire. The 10.5% low GILTI rate, which is for your global intangibles income, which is
I don't know anything about this stuff, clearly. Keep going.
It goes up to 13.125, which of course some people care about. And the foreign derived intangibles income tax, or FDII, goes up to the god-awful high rate of 16%. So there are some ratchet ups. So what happened with the Tax Cuts and Jobs Act? First of all, the corporate side was a total revolution. Before the Tax Cuts and Jobs Act, the U.S. had a system called deferment, or deferral, where profits earned abroad, in theory, were taxed at the U.S. headline tax rate of 35, but only if the profit was returned to the United States. Profits were never returned to the U.S. Companies borrowed against their offshore profits, and that was essentially a system that sort of worked. But it meant that U.S. companies had on the U.S. side of their balance sheet a lot of debt, and on the foreign side of their balance sheet a lot of assets. It wasn't great. So the main thing the Tax Cuts and Jobs Act did was it got rid of deferral. You pay tax as you go. Once you pay your U.S. tax, you're free to move your money wherever you want. That was supposed to bring a lot of money back. It obviously lowered the headline tax rate from 35 to 21. It created this new global minimum on intangibles, which is sort of a strange concept, but essentially intellectual property, that everyone pays on their global income. So in theory, it's now territorial, but it's not entirely. And then it created a separate low tax rate, the foreign-derived intangibles income tax rate, for companies that moved their intellectual property back to the U.S. and used it to export. Pharmaceutical companies make most of their profit, although they don't say it, on their U.S. sales. They preferred to keep their intellectual property and production abroad and remain in the 10.5% GILTI bucket. So no change there. Apple, same thing. Microsoft, broadly the same thing. But some companies did adjust. Facebook and Google returned their intellectual property to the U.S. You see this very clearly in their corporate returns, and now sell their intellectual property to their Irish subsidiary, where they book most of their ad revenue globally. Qualcomm has also adjusted its global tax posture. So it's not a story of no change, but it is a story of mixed change. And it is a story where, at least in my view, the 6 biggest pharmaceutical companies clearly pay less to the U.S. government after the Tax Cuts and Jobs Act than they did before, because they actually had to bring some money back from their offshore tax subsidiaries at their 35% to cover their ongoing cost. And Apple now, mostly for even more complex reasons, but Apple books more of its profit in Ireland than in the United States. And Apple is now paying roughly as much in tax to Ireland as it is paying to the United States. That's why Ireland has a sovereign wealth fund. So there are still changes that could be put in place that, broadly speaking, wouldn't significantly increase the corporate tax burden, but would increase the amount that the biggest and most successful U.S. companies pay in the U.S. So hence, you broke my heart. You said there's nothing to be done.
It was just me being ignorant. It was just me being ignorant.
I realize I should have said this in the intro, but in addition to writing and researching and tweeting about all these issues, you also have real life experience when it comes to trade policy. You were an advisor to U.S. Trade Representative Catherine Tai, who has also been on the show. Maybe you can't get into specifics here, but give us a sense of what the most surprising thing was when you were actually in that advisor role when it comes to the construction, the realpolitik, I guess, of making trade policy.
I guess one surprise, and it's just a cultural thing about USTR, as I previously worked at the U.S. Treasury, is that financial markets, which are the obsession of this town, presumably this crowd, are weighted at about 0 in USTR internal decision making. People do not get a report on what happened in the market at the start of a significant meeting at USTR, whereas that would be kind of the norm at the U.S. Treasury. So culturally, it's not driven by the market. Culturally, U.S. trade policy is driven by lawyers, and lawyers care a lot about process. So I think what surprised me the most is the weight that is given to following the procedural niceties of the various different trade laws, which I think are actually quite relevant if Trump were to win, which I personally certainly do not hope is the case. But those procedural niceties become constraints on how quickly he can restart various trade wars.
You mentioned in the beginning that globalization continues despite all the memes and despite all the narrative, but you described it as an unhealthy form of globalization. Was there a point where it was healthy in your view, and is there a turning point where the globalization process went from healthy to unhealthy?
So in general, I think globalization in the 1990s had a different impact on the U.S. economy than globalization after the 1990s. If you look at trade patterns in the 1990s, and there's a significant interruption in the Asian financial crisis, and I think most people in Asia would say globalization went wrong in the 1990s. But during that period, broadly speaking, exports and imports were both expanding symmetrically, and you didn't have an expansion and explosion of the offshore balance sheets of big banks and their special investment vehicles, like the obsession of Wall Street in the pre-global financial crisis period. So to me, that was a healthier form of globalization. What went wrong? Well, a technical thing, check the box, made it really easy for U.S. companies to shift intellectual property offshore. That unleashed a wave of tax-driven globalization that we have not yet, in my view, been able to rein in. It created incentives where ever-broadening sectors of the U.S. economy. So one of the things I point out in the Aspen Economic Strategy paper is that semiconductor equipment manufacturing, actually a pretty strategically important industry, has between 2005 and 2023, 24, moved a lot of its manufacturing and all of its profits to Southeast Asia. Why we thought that was in our strategic interest is beyond me. But it wasn't just a one-off. It's been a continuous process. And then obviously China enters the WTO, the Chinese surplus explodes. And I think that generated a period of unhealthy globalization as well. And so that's why I'm a little worried right now that the increase in China's surplus, judged on a global basis, not on the bilateral basis against the U.S., is on a magnitude comparable as a share of world GDP to that seen immediately after WTO entry.
There seems to be some consensus about diagnosing the problems in the Chinese economy. So not enough domestic consumption, too high savings, et cetera. And yet it still seems relatively committed to the export-driven model. Why is that?
The pithy answer would be that there can be no consensus in China that doesn't include President Xi. So actually, I don't think there is consensus, because I think President Xi doesn't share this diagnosis. I think President Xi, generally speaking, views support for households as unproductive, and he views investment, particularly investment in high-tech sectors, as productive. the intellectual leap that giving checks to households, taking less from households, lets households spend more and therefore supports investments, not just consumption, but it supports investment throughout the economy, is not one that President Xi obviously shares. So yeah, I don't think there is yet consensus.
One of the things that people love to talk about is just forever, for as long as, is the future of the dollar. Mm-hmm. And, it's just one of those things. People just love to talk about it.
I've noticed.
Yeah. When you look at
it is not a topic that I prefer to talk about, but I will talk about it. No.
We don't have to talk about it.
You can talk about it.
All right. Tracy, when she introduced, she said we could ask Brad anything. So this is on my mind. When you look at unhealthy globalization, do you see any strains on the dollar regime or any reasons to think that there is going to be a meaningful change in the trajectory of dollar usage, either within the trade for goods and services globally or the use of dollar in financial transactions globally?
Not really. So there has been one obviously important and significant change, which is the sanctions on Russia. Russia is one of the top 10 global economies, produces a lot of oil, and the world wants oil. We, meaning in this case the US, the EU, the sanctioning coalition, the G10 countries, have generally not actually sanctioned dollar and euro payment. But even though we have not sanctioned dollar and euro payment, Russia obviously is very concerned that we could, particularly because we've frozen all the central bank's assets, and that was a pretty big step. Russia, to be fair, was the country that did the most before 2022, the invasion, to reduce dollar usage. Didn't get rid of it, but Russia had moved almost all its reserves out of the dollar. It had certainly removed all of its reserves out of visible dollars, stuff that the US can see in this normal data reporting. And it had migrated to basically using the euro for most of its oil and gas transactions. Now that you could say that's just logical. Russia traded mostly with Europe before the invasion, but it was using the euro to denominate trade with China, not the yuan, not the dollar. And I think the main lesson of the sanctions has been that if you want to diversify out of the dollar and you want protection against sanctions, which is the one thing that you get with diversification out of the dollar, diversifying out of the euro isn't diversifying far enough. So you essentially have to diversify into using the yuan. Now, the yuan has a bunch of disadvantages. The yuan is not accepted globally. If you're an African country and you get yuan for selling something to China, you can't use that yuan to buy stuff from your neighbor. It's not that kind of global currency yet. The dollar and euro are. And in general, holding financial assets in yuan means you've been holding a depreciating currency with lower yields than in the dollar. And then, by the way, China uses its geopolitical and mostly it's been over its trade leverage pretty aggressively. And you would have to assume, if you have a lot of your financial assets in yuan or your trade is denominated in yuan, that you are potentially subject to Chinese financial pressure. So you get a little bit of defense against US and European sanctions, but at a pretty significant cost. And you just don't see it. So one anecdote, because anecdotes are a little interesting. It was sort of striking to me because I hadn't been to China for quite some time. I was a little nervous about it, to be honest, and heard a bank treasurer from a big Chinese bank talk about how they were thinking about the world and what that Chinese bank was worried about. Well, I was worried about the fact that yuan lending rates were being forced down. And that was squeezing yuan net interest margins. And fair things, that's what all banks tend to worry about. Although it was striking to me that this bank treasurer was more or less saying, the official lending rate, which the Chinese have been de-emphasizing, was actually really important. Other thing he was complaining about is, well, there's all these lending quotas. Again, I was like, I thought you'd reformed your commercial banks. You weren't doing quotas. No. Quotas for manufacturing, quotas for lending to innovation. The treasurer obviously was sort of implying quotas that required us to lend to companies that were going to generate losses in the future. So what was the great hope Well, they looked at the Japanese banking system and discovered that the Japanese banks do this great dollar business that generates half their interest income. And they looked at that with envy. You could choose your own interest margin in dollars, and you weren't forced to lend to loss-making companies in dollars. So just as an anecdote, you see growth in the dollar business, offshore dollar business of Chinese state banks, which completely runs against the de-dollarization narrative and is very much a function of China's own domestic weakness. So I think that, to me, that was telling.
You had a great line in the paper, just going back to the lending quota point, but you said free markets appear to favor a country that hasn't freed its own market, i.e. China has probably benefited the most from the trade liberalization of the 1990s and early 2000s. Why is that?
Well, again, Tracy, thanks for really closely reading my paper.
I try.
I actually thought that was a good line. You were the first person who's noticed it. I throw in, hopefully, some witty quips in a 40-page paper just to test to see if anyone actually reads.
I passed.
You did. Look, I am not the first to make this observation. I think it's an observation that has influenced politics and policy in the United States and in Europe. China does not have a full market economy. The government runs the banking system. The banking system still dominates the distribution of credit within the Chinese economy. It favors some sectors over others. The Chinese state, in its many layers at the central government level, but also at the provincial level, provides a lot of equity investment for Chinese companies. And so you can argue that China doesn't just have one industrial policy, it kind of has 20, because all the different provinces have their own industrial policy trying to build up provincial champions that become national champions. And in the process, they get cheap capital, very cheap capital. There isn't the private equity industry in China exists, but it's not demanding you lever up to get a 15% internal rate of return. It exists to provide a bit of a veneer of private capital for investments in strategic sectors. There's a lot of patient capital that has gone in to sectors that are quite capital intensive and that are willing to accept high risk and low rates of return, in part because it is state capital. And as a result, in those sectors where this internal competitive hothouse generates globally competitive products, production migrates to China. So that is the trend that was famously exhibited in the solar industry. Joe loves excavators. It's a slightly different story. But 20 years ago, China was importing a lot of excavators actually from the United States. Then Caterpillar sets up shop in China. Then a bunch of Chinese companies with state capital backing them, they're not all state-owned, get into the excavator business. Then Chinese demand for excavator goes ballistic with the property market. Then the property market tanks, and guess who's exporting excavators to the world? China. So, and obviously everyone's petrified that this same pattern will replicate itself in electric cars and potentially legacy semiconductors and potentially cutting edge chips, but there's a little tech war going on to stop that.
If Trump wins tomorrow, look, it seems very plausible that we could get some sort of radically different approach to everything, certainly on the trade front. So let's just sort of accept that that's, again, per the models and the aggregators, a 50% chance. If Harris wins, as you see it, what are the priorities when looking at unhealthy globalization? Not like necessarily what she's thinking, but from your perspective, what are the priorities towards addressing this unhealthy version of globalization that you described?
Look, well, I would start to some degree with some of the points that Secretary Yellen and Lael Brainerd have made about China's own unbalanced economy. And fundamentally, the U.S. has, in my view, an interest in a more balanced Chinese economy. And we have an interest in convincing our allies and partners to also join us in putting pressure to get a more balanced Chinese economy. That's a long, hard slog. It depends a bit on choices China makes. So one interesting example, at least I find it interesting, Trump talks a lot about replacing the income tax with tariffs. That's been one of his ideas. It's unclear if he's actually going to do it, but it's an idea. China currently collects more revenue from tariffs than from its personal income tax. It already has achieved this, partially because it still has somewhat significant tariffs, and partially because it only collects 1% of GDP in personal income tax, which is a very low number. We collect 8%. So that, to me, is necessary. It's a part of the broader policy package that generates a more balanced Chinese economy, but it is not something that the U.S. Congress can change. So the other component for addressing unhealthy globalization is something the U.S. Congress can change, which is the U.S. tax law. So my immediate priority, if I were giving advice to hopefully President Harris, would be, look, there's a budget negotiation. Washington, D.C. will be consumed with the expiration of the tax cuts. 2025 is a fiscal year. It is a year which is set up in D.C. to debate the structure of taxation. And Republicans, and this is conventional wisdom, have an incentive to come to the table, because if nothing happens, we have a cliff and all of Trump's personal income tax cuts expire. Republicans don't go to Washington to raise people's tax. So they have an incentive to bargain. And my hope would be, as part of that bargain, some of the remaining incentives in the corporate tax code that have clearly encouraged or not discouraged the migration of intellectual property and production outside the United States get addressed. That'd be where I'd start. I also think one of the tensions, one of the tensions in Trump's trade policy was that bilateral tariffs are way less effective than he thinks. You can get around them really easily. You put 95% Chinese content, a few screws in Southeast Asia, you go to a 0 tariff rate. It's trivial to get around with a little bit of work. So bilateral tariffs don't really work, but Trump loves them. One of the tensions in Biden administration views on trade, again, widely accepted, is that the Biden administration talked a big game about friendshoring, working with allies, and then, thanks to Joe Manchin, your friend, very important U.S. senator. Thanks to Joe Manchin, we have an Inflation Reduction Act. And thanks to Joe Manchin, that Inflation Reduction Act didn't treat our friends very nicely. So I think there's a lot to do to kind of harmonize our industrial policies with our allies. And they have to make some changes too. I think the Europeans are ridiculously obsessed with following a super strict interpretation of what the WTO allows, which means that they won't do Buy Europe on their EV subsidies inside Europe, even though China clearly did Buy China on its EV subsidies inside China. They just didn't write it into the law. They just never qualified a foreign-made car. Actually, initially never qualified a battery made in China by a foreign company. That only happened after the Chinese companies, which now dominate global batteries, got a good foothold. China has been super restrictive, and I think Europe should be symmetric, do a kind of Buy Europe deal. And my idea is that, we have Buy US, you have Buy Europe. We will, this is what I learned at USCR. You can deem European or allied goods to be American for purposes of qualifying for US subsidies. And we would offer to do that if Europe would deem American goods to be European for qualifying for European subsidies. So we kind of each create an open market towards each other while being pretty restrictive towards China. So those are, I think, to me, the cutting edge of policy in the Harris administration.
Would you be open to a potential position in a Harris administration?
I had a suspicion, you might ask. I have never turned down an opportunity to serve my country.
So that was our live recording of the podcast at Caveat in New York. I can't believe after all that it's actually election day now.
Wait, did we find out last night who was going to win? I forgot. Did anyone? I think that's the one question we forgot to ask. We should have.
Put everyone on the spot.
Yeah.
Maybe not.
Okay.
But we hope if you came to the show that you enjoyed it. We are hoping to do more of these events in the future. So if you liked it, please let us know. And in the meantime, a big thank you to everyone who worked to make this possible, notably Carmen Rodriguez, our producer, and Kate Seabury at the Bloomberg Events team, as well as the entire crew at Caveat.
Thank you so much. And again, we'll do it again in 4 years. But other things in the meantime.
Shall we leave it there?
Let's leave it there.
This has been another episode of the Odd Lots podcast. I'm Tracy Alloway. You can follow me at Tracy Alloway.
I'm Joe Weisenthal. You can follow me at The Stalwart. Follow all of the guests that we had last night. Follow Zoe Liu. She's at Zongwen Zoe Liu. Follow Jordan Schneider. He's at Jordan SCHNYC. Follow Zvi Mowshowitz. He's at The Zvi. Follow Neil Dutta at Renmac LLC. Follow Skanda Amarnath at Irving Swisher. And follow Brad Setzer at Brad_Setzer. Follow our producers, Carmen Rodriguez at Carmen Arman, Dashiell Bennett at Dashbot, and Cale Brooks at Cale Brooks. Thank you to our producer, Moses Andam. For more Odd Lots content, go to Bloomberg.com/oddlots, where we have transcripts, a blog, and a newsletter. And you can chat about all of these topics, including the election, 24/7 in our Discord, discord.gg/oddlots.
And if you enjoy Odd Lots, if you like it when we record live episodes and then bring them to you in not quite record time, but very efficient time, then please leave us a positive review on your favorite podcast platform. And remember, if you are a Bloomberg subscriber, in addition to getting early notification that we are hosting these live events, you can also listen to all of our episodes absolutely ad-free. All you need to do is find the Bloomberg channel on Apple Podcasts and follow the instructions there. Thanks for listening.